Let's get across the market open now. Kyle Rodder joining us from capital.com. Kyle, welcome to Monday. Good to have you back on the show. So, markets got very excited, of course, on Friday where the Strait of Hormuz was open, but of course, a lot has changed in the meantime.
Certainly, and I mean, it's probably fair to say that at no point really was the Strait open at all. There was a few vessels that got through, but have been quickly turned around, and I think it highlights again just sort of the level of complacency that even if a deal does get done, it's not going to be a smooth process here. And, effectively we are still in the world where the Strait is closed. It has been for 6 or 7 weeks, and we're coming to a pretty crucial cliff in global energy markets shortly, where the true impacts of this shortage and supply deficit will start to be felt. So a really gappy open today. You've got all the typical moves of oil higher, futures down, stocks will probably be on the back foot throughout the Asian session. And really, I think in the next 24 hours, we're going to be looking for signs, obviously, of escalation or, potentially on the flip side of this, the kind of typical headlines that normally come out of the US this time of the week of progress, peace talks, happy vibes from the Trump administration. It's all to say that, we're back to a situation now where headlines are going to drive the narrative and therefore, obviously, volatility as well.
Yeah, I mean, we've got statements and then counter statements coming from both sides. President Trump saying that negotiators will be in Pakistan tonight, but the Iranians saying, no, they're not going to be there. So it remains to be seen. Very hard for any investor to get their head around what's to come.
Yeah, without a doubt. And I think, what's sort of problematic here is that, first of all, doing a peace deal between two, traditional fierce adversaries was always going to be difficult, especially on the terms that are being discussed. I think there is hope that there is fairly strong incentive from both sides to do a deal here because, obviously Iran doesn't want to be fighting this war for ever either. It's coming at a fairly significant strategic and economic cost for them. The United States has arguably been in a situation where it's been playing catch up since the initial strikes, perhaps a little bit of a miscalculation, and there's very strong domestic incentives to try and end this war, claim a victory, and at least start to clean up the mess a little bit. I think the problem is that the US isn't actually negotiating with a single entity here, or at least a unified entity representing the Iranian regime. There are fairly significant forces against doing a deal with the United States, specifically sort of the more hardliners in the IRGC that would prefer to keep fighting, prefer not to, trust the United States, and that's kind of clashing with the more moderates in Parliament in particular, and arguably President Pezeshkian, who, simply wants to get this conflict over and done with, and try and at least mend the damage that has been done to, again, the Iranian military and the Iranian economy. So this is the problem here. It's a sort of a moving feast to some extent, and it just shows that even if there is progress, or if the ceasefire holds and that a peace deal is eventually done, that the path there is not going to be smooth. It's going to be rather bumpy, and again, for markets, that means volatility.
Well, I mean, when you take a look at what's going on in the equity market, particularly Wall Street, Carl, record after record, extremely bullish sentiment there, despite what is going on more geopolitically.
Yeah, and I think this is fundamentally an earnings story, and crucially, we're coming into the real sort of meaty part of US earnings season. There's a compulsion in the markets to try and provide some kind of very large, unified, synthesized narrative as to how we've gotten to this point to start with. But there's probably a number of forces that have pushed equities higher over the last few weeks, both technical, fundamental, and some of them just clearly, sort of narrative driven when it comes to the war. But, if you were to provide the really strong fundamental thesis as to why equities have surged the way that they have, is that with the drawdown that we got throughout March, we didn't see the analyst community revising particularly much the earnings outlook. Valuations look very attractive as a result, and earnings season so far has been, reasonably robust, and investors, basically want to pay up, take that risk for future profits, especially as geopolitical risks diminished. What is interesting from here, even just separating the headline risk over the next few days related to the war and its markets try to, really flesh out the impacts of the energy crisis, is that we haven't seen any signs yet in analyst forecasts, and not that much yet in terms of guidance from corporates about the fundamental impact the energy crisis will have on growth, both via, probably higher costs and as well as sort of lower revenues, just because of, the kind of inflationary and economic activity impacts of this energy crisis. So I think that will really be the next test, or I should say the test after this kind of more headline-driven stuff for the markets, is that can earnings live up to the high expectations that analysts have more or less laid out, that don't seem to be factoring the impacts of the energy crisis, and whether that starts to manifest in a market that maybe at least takes a little bit of a breather, given that, again, we've pushed so aggressively to record highs.
And what are you seeing here locally, Carl? Because those gains more muted. Nonetheless, we've sort of we are higher. What do you see the dynamics at play here in Australia?
I think the problem that we could be running into here is that, we have the composition issue. The real driver of strength for the market has been, in the United States, the tech stocks in particular, and we have a very low weighting towards tech stocks. We have seen a very strong recovery in tech stocks for the ASX 200. The issue is obviously cyclicality. The issue is financials, which are also being hamstrung by the fear that there will be further interest rate hikes from the RBA. Bumpiness when it comes to commodity prices, because the on-again, off-again dynamic of, basically the closure of the Strait of Hormuz. And we're likely to see a little bit of support if things continue to progress in the direction of peace in the Middle East, but will probably outperform Wall Street, which again seems to be very much driven by investors looking to pick up good value stocks, mostly in those kind of big tech plays, those AI plays in particular. But when it comes to the session ahead, or the start of the week, we're just basically going to see markets on the back foot, and it'd be interesting to see how the other markets in the region behave, the Nikkei, Kospi, and what have you, given that really the theme of the day once again is going to be energy security and the energy crisis.